Hello, everybody. I'm Dean Orrico with Middlefield, and today I'm really happy to be joined by Jonathan Gitlin, who's the President and CEO of RioCan, and we'll get into a fulsome discussion on RioCan, what it's about, where it's going, but I'll give you a little snapshot here. This is a REIT that's really been one of the key REITs in the Canadian market. At Middlefield, we've had a relationship with the business going back not only years, but in fact, decades. And today, this REIT has 37 million square feet of net leasable area across some 200 income-producing properties. And it's been a core holding across not only our real estate-focused funds, but also in our diversified equity income funds. As I mentioned, I'm really happy to be joined by Jonathan today, who joined RioCan in 2005 and then became CEO earlier this year. And Jonathan has been very involved in bringing RioCan to where it is today, and in particular was spearheading its non-core asset disposition program a few years ago, which again I'll talk about in more detail. But fast forward to today, RioCan is focused on Canada's 6 largest markets, where really we have our major population centers. About 90% of its assets are in those 6 markets, and the business is evolving, and it's now become one of the leaders in ESG compliance and ESG practices, which again we'll get into a little later on. So thanks for joining us, Jonathan.
My pleasure, Dean. Thanks for having me, and thanks to all of those who are watching for taking the time.
Excellent. And our viewers here, Jonathan, are both going to be in Canada as well as in the UK and Europe, where we manage portfolios for UK and European investors. So maybe for their benefit, give a brief overview of who RioCan is, how it's positioned in the real estate market.
Sure, happy to do that. So RioCan has been around for 27 years, and in the North American context, that doesn't seem like that long, but in the Canadian context, it in fact makes us now the longest standing REIT. Some of the others that were formed around the same time we were have either merged with others or faded away. So we do have that standing, which we have a great legacy, a great history. Which is important, but more importantly, it's our future that I like to focus on. But the important element of that history is really twofold. One is that we've been able to build up what I think is the best platform and team in the business. Just having this much experience under these within these 4 walls, and the ability to have built up and curated that team over the last 27 years has really benefited us, and I think distinguishes us in many ways. And I'm very proud of that team and what we've been able to assemble here. And then the other really is just the benefit that we have of owning properties, land really, that we've been able to assemble over those 27 years. When we bought them, whether it was 10 years ago, 15 years ago, 20 years ago, we bought them because they were well-located shopping centers. And now they are still well-located shopping centers, but we look at them through a bit of a different lens in that they are exceptionally well-located properties that can be used for a number of things. And what we've been focusing on, particularly over the last 5 or 6 years, is how we can take those properties, and whether it's just bettering the retail or going as far as knocking down the retail and building these fabulous mixed-use communities. We have that capability in-house, and that's what we've been focusing on. So it's the fact that we've been around for 27 years, buying these properties in these neighborhoods that have since transitioned and become very prominent with great demographics. It really sets us up well for the future, which, as I said before, that's my focus. That's the team's focus here. But as Dean alluded to, we have 200 income-producing properties, a number of development properties that are by and large mixed-use communities that are on transit, and we'll get into that, I suspect, more as we progress in this interview. And we are fully vertically integrated. We've got the capabilities to asset manage, to develop, to acquire, to property manage. And as I said, we have a deep team of close to 600 people. We are located across Canada. We have offices in the major markets within Canada. And again, I apologize for those of you who are Canadian and understand these dynamics, but for those of you who are not domestic, Canada is a massive landscape, but really there are 6 cities that have growing populations, bettering demographics, and those are Vancouver, Calgary, Edmonton, Toronto, Ottawa, and Montreal. And that's really where, as Dean alluded to, our focus has been over the last 10 years. And so now we're proud to say that well over 90% of our income comes from those 6 major markets. And more importantly, over 50% of our income is coming from the Greater Toronto area, which I liken to, it's a North American city more than just a Canadian city. It's growing and it has so many things going for it. So for us to really put our stake in these lands in this city is I think a very good thing for us to do. We are Canadian strictly. We were in the United States for about 7 years earlier on in the last decade, but we did exit that market, and we did quite well by doing that. But we are strictly Canadian. So that's the high-level overview. There's a lot more to us, but given the time constraints, I think that'll give you a good sense.
Well, that was helpful, Jonathan, because I think what I heard you talk about was both your physical capital, where you're positioned physically, but also your focus on human capital. And we know the challenges in running a business these days and finding good people and retaining people. So it sounds like that's a real focus at RioCan. So I want to break up this discussion into 2 segments. And really the first end is going to be a bit more brief. And I want to talk about kind of where we've been in the last couple of years, particular focus on the pandemic. And in Canada, although we had a relatively slow start, we fast forward, and today about 85% of Canadians, eligible Canadians, have at least 1 dose. 80% are fully vaccinated, which is great news. And why it's important to businesses and businesses like RioCan, because we know the vaccinations are effective, and really that gives government officials that confidence to continue to reopen economies. So given that really ramp up in vaccinations over the last 3 or 4 months, how has that impacted RioCan and its discussions with tenants and leasing in particular?
Mm-hmm. Well, I mean, my God, it's been a very oscillating set of circumstances here in Canada, where for months and months and months after the vaccination became available to the world, once Pfizer, Moderna, AstraZeneca, and others said, we've come up with this vaccine, we were slow to start in procurement here in Canada. And I think there was a lot of criticism around that process. It wasn't a question of a lot of people saying they wouldn't get the vaccination. It was a question of how in the hell do we get the vaccination? And then, and because of that, we were probably the most locked down jurisdiction in the world. And in fact, Ontario, which is the province in which Toronto resides, was only open for the most part for businesses in late June. And that lagged behind many other major jurisdictions in the world by months, which seemed like years when it was going on. And so I would say there was a lot of frustration as a business manager. There was a lot of frustration as a citizen, because we were saying, okay, why is every other country getting millions of doses and we're not? But then, the pendulum shifted very quickly, because once the supply started coming into Canada, we're a well-behaved nation. And I think a lot of people just stepped up and said, let's get this vaccine. We didn't have a lot of the same protests and I would say ambivalence that certain other countries have. And very much consistent with the history of Canada, that all worked in our favor. And I think that the vaccination ramped up, as you suggested, very significantly. And by the summer, we were at these high levels amongst the world leaders in terms of how many people are vaccinated. At this point, we've got, I think it's like 85% of Canadians, as you said, have vaccinations. And so that made it eased the burden, and it eased the pressure on a lot of our retailers, because the moment they were able to open, people felt pretty safe about going to shop. And that allowed these retailers to really start operating their businesses quite substantially. And it was perfect timing, because our government has been very active in supporting the tenants who were shut down, particularly the medium and small sized businesses. And so the end of that support, it's still actually ongoing, but it's gonna lapse actually at the end of October. It dovetailed nicely with the reopening of all these businesses. And what we're seeing now is a sustainable upward momentum of consumer activity, which, as you know, I think the whole world is seeing. When you had 18 months of demand basically pushed to non-existence, a lot of people saved money, and a lot of people psychologically were thrilled with the notion of going out and eating in restaurants and visiting gyms, and they really sort of stepped up and started shopping again. That really helps what I would say is a small segment of our tenant base. But the fundamental point that I'm going to make, Dean, is that the larger segment of our tenant base actually wasn't really impacted by COVID and the shutdowns, because RioCan is at its core a provider of essential, non-discretionary retail. Grocery stores, pharmacies, liquor stores, dollar stores, all of these types of retailers actually remained open during the course of the pandemic, and in fact did better during the course of the pandemic. So they have been healthy, they continue to be healthy, and therefore RioCan has been quite healthy throughout the course of the pandemic. I mean, we definitely had a rough road, and some of those smaller tenants were definitely having trouble paying their rents for a little while. But as I said, they're a smaller segment of our overall tenant mix. So the pandemic has absolutely impacted us. The vaccinations have, on the other hand, helped us significantly, and I think our tenants are in a much healthier state right now. But as I also suggested, the bedrock of our retail portfolio has been pretty well sustained and held up throughout the course of the pandemic. And then shifting to residential, I think we did see a lapse in leasing, in residential leasing. There was a lot of household consolidation here in Canada. A lot of people moved back to their parents' basements and started just sort of saying, well, if I'm working from home, I might as well just go to a bigger environment and save some money. And that phenomenon is starting to lapse. And so we're seeing the effects of that. So our residential leasing is getting much better. And our office portfolio, which makes up about 7% of our overall revenue, I would say that's soft. It's not, it's definitely slowed down. Our occupancy in office was at 97%. It's now closer to 92%. We think this is a temporary shift while people figure out what their office needs are. It's a very bizarre time, for office use. But I suspect, again, given the locations of our office properties, given that there's not a lot of competition around where we own office, that is a transitory trend, and it'll get better.
I'm glad I heard you say there about focus on essential services, because it just reminded us, having followed the company for years, decades, when we saw where RioCan was trading last fall, we just thought, just given the profile of its tenants, where the income was, where we thought the income was going to be, it just looked like such an unbelievable opportunity. So we bought a lot of stock, last fall, which has turned out to be, a great entry point or a top up for us. For the business. So let's kind of look at where we're going from here. So we've seen this transition in the business, this evolution in RioCan's business over the last 4 or 5 years, as you say, into more mixed use development. And I think today RioCan's got about 40 million square feet of development in its pipeline, which I think is amongst the highest of any REIT in Canada. And about a third of that, as I understand it, is for mixed use assets. And having done this for some time, Jonathan, you've been in this business a long time too, that, years ago, companies that were more pure plays and real estate businesses that were more pure plays often got a premium valuation, because as investors, we thought we like a pure play because that's one we could understand. That's where you're focused, your core competency, et cetera, et cetera. But today, almost by necessity, companies are becoming more diversified. So talk about your development pipeline and whether you think that's really going to be benefiting RioCan's valuation, being more diversified as you look forward the next 4, 5, 10 years.
So I would say it's not necessarily out of necessity. I think it's out of a really, optimal view on allocating capital and really taking advantage of some exceptional land holdings. To us, really what prompted us to start getting into, and I'll clarify, it's not necessarily just pure play residential, they're all mixed use. When we do them, there's usually a retail component with residential above. And for us, what prompted us to shift into that wasn't this fear that retail was going to be under pressure and that residential is a better or different asset class. It was rather that if we sat on our hands with all of these tremendously located, transit-oriented pieces of property that were literally covered by a building, I think 25% is the average coverage we have. Most of these great properties are parking lots. Are we really doing a service to our unit holders? The responsible asset manager says you're doing a disservice. You've got to actually look to get more value out of these properties. And what's the best way to create value? Well, sometimes it was just bettering the retail, maybe upgrading that retail. But in many cases, particularly when you're on transit, the better move, the more optimal move was to actually gain that expertise in mixed use and get zoned for or entitled for these great mixed use developments. And we also felt that when you can marry retail and residential and you own both of them, you form a really tremendous, like the sum of the parts is better than the individual aspects, because the really well curated retail serves as an exceptional amenity to your residential tenants. And the retail tenants really benefit from having the residential above. And the reason I point that out is because there's a lot of developers, merchant developers in the Canadian markets that develop the retail podiums as an afterthought. So, I'll make my money on the residential. The retail needs to be there, but we're not going to care about it. So they put demising walls in odd spots, and they put support frames in weird places, and it makes it actually illogical retail. And then they'll get tenants in that actually don't help properly serve the communities above them. We're a little more focused, because we own both, on making sure that marriage works, and I think that serves to benefit us. But in terms of our pipeline, so that was sort of the impetus for us starting to rezone and get these properties built up a little bit. And and the other thing, just to remind some of those who aren't from Toronto or some of the other cities in Canada, transit is not ubiquitous here. Transit is very much underserved. We've got a city here of 6 million people, and our transit line, if you look at our Toronto Transit Commission map, it's literally like 1/10 of London's tube system. It's actually embarrassingly light. And so that means that when you own a property on a transit line, its value to both residential or commercial customers, tenants, etc., is that much enhanced. So we really do feel an obligation to make more of those really well-located transit-oriented properties. So we started embarking on these rezoning activities, and we put resources towards it literally 10 years ago, Dean. And that 40 million square feet, while not all of it is entitled, those are legitimate, bona fide development properties that over time we'll just pick off one by one, and we have a nice cadence to our development pipeline, if you will, that we'll continue to exploit, and we'll continue to deliver great NAV creation opportunities and just better our brand going forward. The other thing I'll add very quickly, because I don't want to ramble, is that developments, a lot of people say, oh, you've got zoned land, you've got entitled land, that's great, you're good to go. But what I'll tell you is that there's a lot more to readying a site for development than just that. And what we've been doing over the last 10 years is focusing on all of those elements. And to quickly expand on that, you've got commercial tenants who are great until they're not. They're great because they serve as income producing. Well, they're income producing, which is what we as a REIT really like. But when you want to shut them down to build, that's a big exercise, and it takes a lot of negotiation and a lot of time to deal with that. And once you have that freedom, once you've removed the tenants or you have rights to deal with those tenants, that's a huge, huge, huge step forward. Beyond that, you've got to make sure the market is ready for the residential or mixed use that you want to build. And so, zoning is a big part of it, but not all of it. And we've worked on all three of these hurdles, if you will, to ensure that our properties are really ready to go. So that 40 million square feet isn't just some fanciful number. These are properties that we've worked on for, many of them are rezoned, and many of them have rights that can allow us to exit those tenants when we need.
Yeah, you made a couple of excellent points there. One on the transit, because I'm sitting here in First Canadian Place, really at center ice, in downtown Toronto. And I can tell you, having been in this building for 25 years, the traffic is getting worse by the day, not better. So transit as a result is really becoming a major solution. And two, I think the fact on the zoning, people think it's really quite easy to get something zoned and built, but that gets back to your team and the point you made earlier about having the team in place to ensure that you can get these properties done on time, on budget, and get all those approvals done, I think is really important in respect of getting that development pipeline, fully realized. Before we step away from your retail tenants, you talked about earlier about how important it is that your retailers be more essential focused, and that's really what's allowed you to weather this pandemic better than a number of other players. But I'd like you, Jonathan, to really punctuate the point by really talking about, how that is juxtaposed against e-commerce, because for people who are maybe just casually observing this transition to online shopping from brick and mortar shopping, how does RioCan deal with that, recognizing that it's quite likely you'll see more people even buying more essential service type of products and goods from online versus brick and mortar? How does RioCan deal with that likelihood as more and more people become more comfortable with shopping online?
So it's a fantastic question, and one that we've grappled with for years. And what I would say about the last 18 months is they've actually helped clarify the role in which brick and mortar retail plays in the overall environment of how the ecosystem, the retail ecosystem of how a retailer or a company delivers goods into the hands of their consumers. And what the last 18 months has allowed us or taught us is that there is a substantial place for bricks and mortar retail in that ecosystem, and that this conclusion that has been rendered that the success of e-commerce is automatically linked to the demise of brick and mortar retail, it's far too simplistic a conclusion, and it's not that binary. Right? It can't be that binary. There's millions of square feet of retail, and it seems to me to be getting more and more packed, not less and less. And so what does that mean? I mean, these are like, I don't want to sound offensive and say retail's great, retail's great. I want to expand on it a little bit. What I think has been discovered in Canada, which by the way has less square footage per capita than our neighbors to the south, and I think it's a bit of a different environment here, which has to be, I think, highlighted before we get into this discussion, because we're starting at a better point. There's fewer competing tenants in each retail category. There's tighter zoning bylaws, which makes it much more difficult to build any new retail, and we have a lot of immigration happening here, even though the last 18 months have slowed down. In any given year, we're welcoming 400,000 or 500,000 new immigrants to Canada with no new retail being built. So that square footage per capita keeps on getting better and better. So let me start with that to say that our environment here is actually a healthy retail environment. But what I think we've learned over the last 18 months is that consumers, by and large, started feeling uncomfortable with the lack of control that they had over how things were delivered to them. I will tell you that my wife, the anxiety level that comes around getting packages being delivered to our house is actually quite tremendous. If there's inclement weather, oh my God, I got to be home to make sure that that package doesn't get wet. If those packages get stolen, or what inevitably happens, you try on or you use whatever is delivered to you and you find out that it just doesn't fit. I've got a pair of pants delivered to me a couple of months ago, and they literally fit like a wetsuit. And I had to go through the pains of sending it back. But if you can then bridge that with an experience where a consumer can actually just simply pick it up on their time, in their control, doesn't have to be entering the store, but it's picking it up from the store. I think that is human nature, and I think that control it has been retaken by the consumer. So what does that mean for our retail tenants? It means that their brick and mortar locations that are so well penetrated into these very high demographic neighborhoods are critical to them for this delivery chain. They are not going to give up on these fulfillment centers that have penetrated neighborhoods. They simply won't. And as the cost to actually own and operate these fulfillment centers in the outskirts of our cities increases because land costs have gone through the roof, the notion of paying rent in these well-penetrated properties becomes a lot more sensible, because the amount of money they save in this delivery process, if people come and pick things up from a store, is tremendously high. So what does that mean for us? It means that we've got to evolve our shopping centers, and it means that the retailers that we cater to have to evolve their ways of delivering goods. So we're doing a lot of this where we're changing drive aisles, we're designating parking spots for click and collect processes, we're helping tenants change their facades, we're helping them create some storage areas and maybe changing some of the, demising in their premises to allow for this hybrid click and collect model, which I think will be prominent going forward. But what that means is that, yeah, you need these types of locations. And I think that is going to serve us as a provider of retail space very well. And like I said, it doesn't mean that e-commerce is going to be any less prominent. I just think the two uses, the two ways of delivering goods are going to merge, and they've already started to. And I think that's what the last 18 months have really shown us. So again, that's our position, that's our view, and that's why we are very comfortable with our retail portfolio going forward, remembering that it is so well located. The demographic profile of these centers is so is actually wonderfully high. I mean, we've an average of 200,000 people living in a 5-kilometer radius. We've got an average household income of over $125,000. These are great things that retailers don't want to give up on. So we feel very strong about the retail that we own.
Yeah, you make some good points about how, that more traditional e-commerce at-home delivery could be very complementary with, curbside or pickup, especially if you've got properties in the right location. So it really does get back to this old axiom about location, location, location. If you've got those properties there, you can actually really complement, this ongoing kind of growth in traditional e-commerce activity. Let's just switch gears here a little bit, Jonathan, in that I want to talk about ESG. At Middlefield, this has become an important focus for us. We've just hired a chair of ESG. We've launched a number of sustainably focused funds, and I was really happy to see some of the strides that RioCan has made in becoming more ESG compliant. I think you might be among the highest rated REITs as far as ESG goes. Talk about, why that's important to RioCan and how you see it evolving.
Sure. So, the neat thing is that back in 2016, we started really focusing on this. It was becoming a question that was asked more and more by our board. It was becoming a question that was being asked more and more by investors. But more importantly, we're a socially conscious group, and we thought, okay, there's something real here. And so we started participating in the GRESB real estate assessment. And I never know if that's GRESB or GRESB, but either way, we started getting knee deep into it. And what we recognized when we started assessing the initiatives that they were asking about, we actually recognized that we were doing a lot of it already, just organically. It was just things that we as an organization had said, this is the right thing to do. This is the way we should treat our employees. This is the way we should think about diversity. This is the way we should think about the environment. And so really it just ultimately became a cataloging exercise of things that we were already doing. And we actually fared quite well in that first GRESB survey that we participated in a few years ago. But we thought it was a good level to start at, but that was just it. To us, it was a starting point. And it was a starting point on a journey that quite frankly will never end, because every year it's part of our mandate now to ensure that we do better than we did the year before. So currently we have a 5-star rating under the GRESB survey. We are, I would say, amongst the highest rated REITs in Canada. It's really, it is now business as usual. It's not some extraordinary thing that we try to do every year. It's just now become part of our philosophy going forward. And every member of our 600-person team is focused on this. But some of the things are just so natural and obvious. I mean, we established a DEI council, which I think has now become fairly ubiquitous. I think everyone did it, but the amount of resources and time and focus that we put on and in this DEI council, I'm proud to say is remarkable. Here in Canada, we are at the end of September, on September 30th, there's a Truth and Reconciliation Day, and the way in which we at RioCan are recognizing it, I have to say it's remarkable about how much participation and and involvement that everyone in this organization is taking in that day. And this is about some of the tragic residential schools that we had here in Canada for our Indigenous population. And I think it's a very important element. This is one small item in ESG, but it's really something that it's just to say that we're not just naming a council and saying, hey, we've checked the box. We really put a lot into it, and it's not just because we feel like it's necessary to placate investors. It's because we really do feel it is the right thing to do. And so we've really embedded it in everything we do. We have certain focus areas that we will continue to focus on, like climate matters. So we are making sure that our climate risks and our opportunities are in line with the Task Force on Climate-Related Financial Disclosures, which goes by the acronym TCFD. As I said, we have that DEI Council, which is something that we are going to continue to focus on. We are doing things like LED retrofits. We have a partnership with this company called Enwave, which is deep water cooling, and one of our preeminent projects, development projects downtown Toronto called The Well. It's actually going to be cooled and heated by this deep water, this lake water that goes into this big tank that we've built under our property. And it's actually not just going to facilitate the heating and cooling in an environmentally friendly and sensible way for The Well, but actually the whole downtown West Toronto core. Things like that really do separate us. We're putting a lot of money towards this, and we feel that it just makes us a better corporate citizen and a better, just a better company, quite honestly.
Yeah, it's really great to see that RioCan is in fact walking the talk, if you will. And I have actually toured The Well, and it's a great example of a mixed use development that I think will become one of those areas that's going to take the downtown core further west and really make it a central area. So it's a fascinating development. We're running low on time. I just want to end on growth. We've talked a lot about your development activities and the strides you're making there and the growth that will result from that development. But I've watched RioCan over the last 20 years really grow by acquisition as well. And I think the reality is in the Canadian market, there are fewer and fewer portfolios that might be available. So maybe just talk a little bit about, Jonathan, how important are acquisitions? Is this an area that you're very active? Are you seeing lots of competition? Is it too expensive? Expand on that.
Well, I'll juxtapose that with the statement that we've just sold about $850 million worth of assets, and we're taking advantage of what I think is a massive disconnect between private market valuations and public market valuations. And we want to always keep a very strong balance sheet, so we raise equity by selling assets, and so. To start buying assets now on the heels of just selling a bunch of them, I think the conditions would have to change a bit. We really are focused on taking advantage of those great land holdings, as you suggest. But where we are seeing acquisition opportunities is really around assembling properties where we own a key piece and we feel that there's a tremendous amount of value to assemble properties around that key piece so that we can ultimately develop it or sell it or bring in a joint venture partner. That's really something we've been focused on, and that's hard to do. I mean, that's street fighting. You have to go into these communities, approach some buyers on sellers on an anonymous basis, and really create this amazing value by just picking off little pieces. And so we've been very active in that regard. With respect to income producing properties, like I said, retail right now, it's got to be very strategic for us to grow through the acquisition of retail. But if I'm looking at how we allocate capital, I think there might be opportunity to actually buy some mixed use properties as long as they fit within our vision of being transit oriented, being major market, being fairly new. Those are things that I think we would look to. And otherwise, I think until we have more currency that is created by a higher unit price, I don't think that we'd go out and buy a low cap rate income producing retail assets. It doesn't serve a strategic purpose at this point. We'll focus more on development.
That makes a lot of sense. As a fiduciary of, a really big balance sheet and a very strong brand name, I think that actually is very logical in terms of how you're approaching it. Well, bottom line is, John, this was excellent. I think this was very helpful to me, certainly going to be very helpful to our viewers. I want to wish you best of luck and thank you for joining us today.
Thanks so much, Dean. As I said, thanks to all the whoever's on this call for joining, taking the time to understand RioCan, and we're always open to answer any questions that you have. But we're thrilled about our trajectory and what we can achieve and all the levers we have for growth. And thanks, Dean, for allowing me to talk about them.
Excellent. Thank you, Jonathan. Have a great day.
You too.